The nation's top earners, they're facing a higher tax bite under President Obama's proposed jobs plan. Individuals earning more than $200,000 per year and couples earning more than $250,000, they could face new caps on tax-free income earned from municipal bonds. My next guest is here to help us sort out these potential changes and the effects that they could have on the muni bond market. Bloomberg Wealth strategist Simeon Hyman joins us, and also with us still, Michael Purves, chief market strategist and head of derivatives research at BGC. All right, Simeon Hyman, let's talk about some of the revenue-raising proposals in the president's jobs plan. It includes some changes to the tax code. Let's start with muni bonds.
Well, this has put a shudder through certainly some individuals' days right now, because they're going to start to have to pay some tax on their earnings from municipal bonds if they're in the highest tax bracket. You'll only get to exclude 28% of those earnings, and if you're in a higher bracket, you're going to pay a little tax on them. So it is a tax hike, particularly for wealthier individuals.
So what do you think that's going to do to the muni bond market? I mean, people have been trying to figure out ways to save their money, not necessarily put it into the stock market. Perhaps they're a little more worried about that income stream. Is this going to change their desire to buy muni bonds?
Well, I don't think it will change the fact that munis will still be the go-to fixed income investment for most individuals, because, look, you're paying 35% tax on U.S. Treasuries. You're going to be paying 7% effectively on municipal bonds. And right now, by the way, municipals are trading at higher yields than Treasuries. So they still will remain at the margin attractive. All
right, so they'll remain attractive, but what will that do to the availability of the funding for municipal bonds? Will it still mean that they're going to be issued in the same numbers?
It probably won't do much, and I'll tell you why. Because that 7% tax that some people will pay is likely not enough to change the supply, because if you look historically, the marginal tax rate hasn't had that much correlation with the discount that municipal bonds have yielded to, say, U.S. Treasuries. I mentioned right now they're actually yielding more, but an average haircut over the years has been more like 20% when the marginal rate has been 35%. So you haven't really seen such a tight relationship that you could say, hey, going to pay a little tax. I guess that means municipalities are going to have to pay 0.25% more in interest, and maybe they'll, have to cut issuance by 10%. There's not enough evidence.
But is there any correlation that those same investors will get out of muni bonds because they'd rather go and try to earn more somewhere else?
Well, still, munis will likely be more attractive, because they're going to be, on an after-tax basis, more attractive to them than other alternatives. And that's likely to persist because there's always somebody out there who's willing to buy muni bonds that isn't that retail investor. Right now we have what's called crossover buying. We have foundations, endowments, we have people in Brazil, Latin America buying muni bonds.
But of course, they don't pay tax.
They don't pay tax.
So they have no need for the tax exemption. So they could buy the Build America bonds, which are taxable municipals, but those are subsidized by the U.S. Treasury.
The Build Americas were very attractive municipalities for just this reason, that they got municipalities got the full subsidy of that 35%, whereas they could only issue in the muni market at maybe a 20% discount to Treasuries in a normal environment. We're in an abnormal environment now where Treasuries are bid up so low, again, that municipals are actually yielding higher. I mean, municipals have been tax exempt since 1895, and that was by the Supreme Court. But in the late 1980s, the Supreme Court said, you know what, we were kind of wrong on that, so we're going to open the door to maybe eliminating that exclusion. So this could be only the beginning, but if it stops here, it probably won't completely roil the markets.
What about other proposals for tax revenue in the president's jobs bill? Changes to medical savings plans, to education plans, indeed, even changes to charitable contributions.
Yeah, I mean, the 28% cap looks like it may be proposed across the board to all deductions. So many of them are, in effect, attempts to shift a little bit of the tax burden to wealthier taxpayers, which is, one of the administration's stated objectives. Many of them are dropping the buckets. The muni as an example, could generate maybe $5 billion a year of extra revenue against a $1 trillion plus deficit. So they might add up to something. If they do, and if they're passed, they might help the deficit a little bit, but most of them are not that big.
Is that a big if, though? If it passes, you think this has a chance of passing?
Well, I'm not a policy analyst, but certainly it looks challenging for anything to get done in Washington right now. But I would say this, don't bet against it, because the presidential election cycle is a sort of well-known phenomenon in the stock market. The third year of a presidential election cycle has been by far the strongest period of performance of the stock market because officials like to get reelected. So there is at least a historical precedence for people resolving their differences and getting stimulative policy out the door. So I wouldn't bet against it.
Bloomberg Wealth strategist Simeon Hyman. Thank you very much for joining us. Appreciate it, as always, Simeon. All right, coming up, we're going to take a look at the outlook for private equity. It's pretty grim. Many private equity firms, they're still reeling from investments made during the height of the credit bubble. Those are those vintage wonderful years around 2005 to 2007. My next guest can tell us about the outlook for recovery in the future of private equity. Antoine Drean, he is the chairman and chief executive of Triago Europe SA. Triago is a Paris-based firm that finds investors for buyout funds. Also with us, we've got Michael Purves, chief market strategist, head of derivatives research at BGC. Good to have you with us, Antoine.
Thank you, Pimm.
The outlook for private equity, I read your most recent report. It's a little grim out there for private equity. What are the sort of benchmarks that people are looking for in order to go and invest money in private equity now?
Well, it's difficult because everything is difficult right now. It's difficult to raise money. The first half of this year, there's probably like 100 billion raised. That's very low to what's been raised during the bubble, like 600 plus billion. Finding debt is difficult when you either exit a deal to another private equity group or buy a new company. And I think that the only positive aspect is that the secondary market will probably boom over the next years.
Michael Purves, what about this? The secondary market, that's the stock market. I mean, you can't sell all your private equity deals to other private equity investors.
No, you're right. You can't flip companies back and forth to each other like the old days. I think one question I had for you is, how does the private equity asset class stack up against the hedge fund asset class in a world where change is happening at ever faster rates?
Well, the issue right now is that, as you know, private equity funds are long-term vehicles. They have money for 10 years. Most of the money that's there right now in buyout funds has been raised during the great years, during 07 and to some extent 08. If you add 5 years to those numbers, you're now, which means that most of these funds have a lot of money to invest. Compared to hedge funds, I think that most hedge funds obviously have a day-to-day market value, which is not the case for private equity funds. The dry powder on the buyout side is roughly $400 billion without leverage.
Right. 400 billion, but without leverage. But you've got, as you wrote, diminishing returns and the decreasing ability to give the investors that significant outperformance, which has always been the big lure of private equity.
Well, you know, private equity 20 years ago was about inefficiencies. It was a tiny market. It was like $25 billion of assets under management worldwide. And
you didn't have a lot of general partners, didn't have a lot of limited partners.
No.
The industry itself was smaller.
No. Today, it's about 100 times that number. It's 2.5 trillion. Many people doing the same thing, actually. Many groups going after the same investments, which means that entry prices are pretty high, and then it's difficult to make money for these funds in the future.
All right, so how do you differentiate yourself? If you want to be a successful private equity entity right now, what, emerging markets, knowledge, specialization, you got to have something that's non-market correlated? Yeah. What's the profile?
When you look at what LP are trying to do right now, they're trying to go into specialist funds. They're trying to invest with people who basically know what they're doing, who have a specialty. So that could be emerging markets, even though there is a lot of money already in emerging markets, and you'd better choose the right team. It could be also sector-specific funds or some talent. You know, in the turnaround space, for instance, there is a lot of demand from LPs and not so many good GPs out there. But the good ones, they attract a lot of money and very quickly.
Michael Purves, have you seen this show up in the equity markets at all? Because, you know, there's usually that flow, right, of the world of private equity. Then they want to sell them into initial public offerings. Have you seen that flow change over the past year?
Well, it's been coming back as the equity markets have continued to come off the March 2009 lows. But you have enormous volatility, and that's the enemy of an IPO. That's the enemy of an M&A transaction. That's the enemy of a dividend recap deal. You just can't get deals done and when the VIX is above 30 for several weeks in a row. It doesn't mean that the deals go off the drawing board forever, but it means that the headlines, you don't get them during these times of volatility.
Antoine, what about new structures for private equity deals?
Well, that's something that a lot of people are talking about. There's not much happening. Private equity funds have been structured the same way for the last 30 years, 10-year lifetime, 2% management fee, 20% carried interest.
Because don't investors want shorter duration? They want to be able to get their money out quicker.
They would like to, but private equity is a long-term game. I mean, except for, 06, 07, 08, where some funds were flipping deals quite quickly. Most of the deals stay in the portfolios for like 5 to 7 years. So, yeah, I mean, investors would like more liquidity. I think they are not getting it through their portfolios because that's what private equity is all about. They can get it from the secondary market, the secondary market for LP interests.
And you see any change in terms of overseas investment? Because I know that you're looking, to connect various investors with various funds. They're looking to invest in the United States. What markets are hot?
Yeah, it's more a micro play rather than a macro play, right? Private equity is about talent, spotting the right team to invest with, wherever they are. We're looking right now at a team in China doing distressed deals.
Distressed deals in China.
So, that's not popular yet, so this is probably one space to look at.
Are plain vanilla deals more expensive because everyone wants plain vanilla cash streams? They don't want any risk?
Definitely. Oh, yeah. For one deal, you have 50 buyers. Obviously, if you win the deal, you may lose money moving forward. Not all of them, but some of them.
Thank you for keeping us informed. Always a pleasure. Antoine Drean joining us from Triago, giving us some insight into the world of private equity. All right, coming up, more on the state of the global economy with my guest, Michael Purves of BGC. And as we go, we've been talking about the debt crisis in Europe and the outlook for the global economy and your portfolio. What do you do with your money? We've got Michael Purves, Chief Market Strategist, Head of Derivatives Research at BGC. He's been my guest for the hour. Michael, are we really setting the stage for the Federal Reserve and perhaps even other central banks around the world to produce some kind of coordinated action to inflate asset prices once again?
You started seeing traces of that today. Clearly, there's phone calls going on between Europe and European leaders and Geithner. We talked about it earlier on the show about the need for some coordination globally as you talk about monetary policies. Everyone knows that trade wars are devastating for economies. And currency wars are, if it's a currency war, it needs to be a friendly war, if you will. It needs to be a level of coordination there. So I think ultimately, if the way things work in the real world is that if the markets get angry enough, that will drive cooperation and discussion to take systemic collapse off the table. That's why it's always a hard bet to bet on systemic collapse is very difficult because you're going up against the most powerful agents and forces in the world, which are the central banks and the nations, really, and they have a lot more power, and they have printing presses as well.
Well, indeed, and when you look at the stock market and previous examples of quantitative easing on the part of, let's say, the Federal Reserve, does the stock market move in anticipation of those events? So could you be seeing a move higher in stock prices because they all think that Ben Bernanke and his central bankers around the world are going to do something?
Really, since Lehman Brothers 3 years ago, the SBX correlation with Fed movements has been very clear and very obvious. So that's something very real. Does it, in August, you were seeing investors saying, oh, well, Jackson Hole, we're going to get QE3. and you didn't get that. But the market didn't really sell off then. So it's not necessarily, it doesn't happen all the time that way. But I think, clearly looking forwards, the market right now would love a nice macro catalyst to take it, to get it out of the sloppy and choppy trading, the spacing pattern that we're seeing right now.
Once again, looking to the Federal Reserve and find out what they do. I want to thank you very much, Michael Purves, joining us from BGC. Always a pleasure, and thanks for your insights.